In March of 2000, the Nasdaq peaked at over 5,000 points. By October 2002, it had lost nearly 80% of its value. Markets collapsed, headlines screamed crisis, and balances that once felt permanent quietly lost their meaning. But the effects of these moments were not uniform across the system, and the pattern has repeated with such consistency that some economists describe it as a structural outcome rather than coincidence. In the year 2000, the dot-com bubble burst. Technology stocks that had soared to impossible heights suddenly plummeted. Entire portfolios vanished overnight. The Nasdaq lost nearly 80% of its value between March 2000 and October 2002. Ordinary investors, people who had poured retirement savings into mutual funds and 401ks, were devastated. Pension funds crumbled. Jobs disappeared. For the average household, it felt like the end of prosperity. But not everyone lost. While the headlines spoke of ruin, a quieter story was unfolding. Venture capital firms, private equity groups, and wealthy individuals with liquidity began buying. Technology companies that had been valued in the billions were suddenly available for millions. Real estate in Silicon Valley, once unaffordable, could be purchased at steep discounts. Assets didn't disappear, they simply changed hands, from those forced to sell in panic to those with the patience and capital to wait. According to some financial historians, this was not the first time such a transfer occurred. It was simply the most visible in the modern digital economy. In many cases, crises function as moments where resources and ownership shift unevenly across the system. When prices fall, those without reserves are forced to liquidate. Those with reserves acquire. 8 years later, the pattern repeated, this time on a global scale. The 2008 financial crisis is remembered as the worst economic collapse since the Great Depression. Housing markets imploded. Banks teetered on the edge of failure. Lehman Brothers, a firm that had survived wars and depressions, vanished in a weekend. Unemployment soared. Foreclosures swept through suburban neighborhoods like a plague. Families lost homes they had owned for decades. Retirement accounts shrank by half. For millions, it was catastrophe. Yet beneath the surface, another process was underway. Central banks intervened with unprecedented force. The Federal Reserve, along with central banks in Europe and Asia, flooded the system with liquidity. Interest rates dropped to near zero. The stated goal was stabilization. But the mechanism had side effects. When central banks buy bonds and inject money into the financial system, that money does not reach everyone equally. It enters through banks, through asset markets, through institutions. The first recipients are not workers or savers. They are investors, corporations, and financial firms. This phenomenon has a name in economic literature, the Cantillon Effect. Named after 18th century economist Richard Cantillon, it describes how new money benefits those closest to its source. When central banks create money, it doesn't appear evenly across the economy. It flows through specific channels: bonds, stocks, real estate. Those who hold these assets see their values rise first. By the time the money trickles down to wages and consumer prices, its purchasing power has already been diluted. In the years following 2008, stock markets recovered and then soared to record highs. Real estate in major cities rebounded sharply. But wages remained largely flat. According to data from the Federal Reserve, the wealthiest 10% of American households owned roughly 70% of all assets by 2016. That concentration had grown significantly since the crisis. The bailout saved the financial system, but it also transferred wealth upward quietly, systematically, invisibly. Some analysts argue that this outcome emerges naturally from the structure of the rescue mechanisms themselves, regardless of intent. When you bail out institutions, you preserve the value of their holdings. When you lower interest rates to zero, you make borrowing cheap, but only for those who already have access to credit. Corporations can issue bonds at favorable rates, buy back their own stock, and inflate their valuations. Wealthy individuals can borrow cheaply to purchase real estate or invest in equities. But for the ordinary worker whose savings sit in a bank account earning nothing, the effect is erosion. Inflation quietly eats away at purchasing power while asset prices climb beyond reach. Then came 2020, a pandemic, a shock unlike any in modern memory. Entire economies shut down. Unemployment spiked to levels not seen since the Great Depression. Small businesses closed permanently. Millions faced eviction. Governments around the world responded with stimulus packages on a scale never attempted before. In the United States alone, trillions of dollars were injected into the economy. Direct payments to households, expanded unemployment benefits, forgivable loans to businesses. On the surface, it appeared to be a lifeline to ordinary people. But once again, the distribution of that money was uneven. According to some economic studies, much of the stimulus flowed into savings for higher-income households or directly into asset markets. Stock prices, which had crashed in March 2020, rebounded within months and reached all-time highs by the end of the year. Real estate prices surged as low interest rates and liquidity chased limited housing supply. Cryptocurrencies exploded. Meme stocks became a cultural phenomenon. It was, in the words of some market observers, the greatest speculative frenzy in a generation. Meanwhile, inflation began to rise. At first, it was dismissed as transitory, a temporary side effect of supply chain disruptions. But by 2021 and 2022, inflation was undeniable. Groceries cost more, rent climbed, gas prices doubled. For households living paycheck to paycheck, the impact was immediate and painful. But for those holding assets, stocks, real estate, commodities, the nominal value of their wealth increased even as the currency depreciated. Once again, a crisis had triggered a transfer. From those whose wealth was denominated in wages and savings, to those whose wealth was held in assets. The pattern is consistent enough that some economists have begun to describe it as structural. Every decade or so, a shock arrives. The causes vary: technology bubbles, housing collapses, pandemics, but the response is the same. Central banks intervene. Money is created. Asset prices are supported. And those who already hold assets often emerge in a stronger relative position than those whose income depends primarily on labor and savings. This dynamic is not limited to the United States. In Europe, Japan, and emerging markets, the same mechanisms operate. After each crisis, central banks deploy quantitative easing, buying government bonds and other securities to inject liquidity. Interest rates are suppressed. Inflation is tolerated as a lesser evil than deflation, and in every case, the primary beneficiaries are those at the top of the wealth distribution. Some historians compare this to earlier eras. In the aftermath of wars, depressions, or currency collapses, wealth has always been redistributed. The difference today is speed and scale. Digital finance allows money to move instantly. Central banks can create trillions with keystrokes, and markets can swing from panic to euphoria within weeks. What once took decades now happens in months, but the underlying logic remains unchanged. Crises force liquidations. Those without reserves must sell. Those with capital acquire at discounts. And when central banks step in to stabilize, they inflate the value of assets, further widening the gap between those who own and those who earn. There is a term used in financial circles: never let a crisis go to waste. It is often attributed to political strategy, but it applies equally to economics. For those positioned correctly, crises are not threats, they are opportunities. When everyone else is selling in fear, they are buying. When credit is tight for most, they have access. When markets recover, they capture the gains. The system operates through mechanisms that are well documented and openly discussed in academic and policy circles. Central banks do not hide their actions. Quantitative easing is announced. Interest rate decisions are public. The transfer is not secret. It is simply invisible to those who do not understand how money flows. The broader implications of these dynamics remain difficult to perceive, in part because the processes unfold gradually and without obvious markers. The language of finance obscures. Terms like liquidity injection, asset purchase programs, and monetary accommodation sound technical and neutral. They do not sound like wealth transfer, yet that is precisely what they accomplish. The result is a system in which crises have become normalized. They are no longer seen as failures to be prevented, but as events to be managed. And management in this context means ensuring that the financial system survives, even if survival comes at the cost of greater inequality. By 2024, the concentration of wealth had reached levels not seen since the Gilded Age. According to research from institutions like the Federal Reserve and various universities, the wealthiest 1% of households in the United States controlled roughly 1/3 of all wealth. The bottom 50% held less than 3%. Globally, the pattern was similar. Billionaires saw their fortunes grow even during the pandemic, while hundreds of millions fell into poverty. Some economists argue this is not sustainable, that extreme inequality creates instability, reduces demand, and eventually undermines growth. Others contend that the system has evolved to perpetuate itself precisely through these cycles of crisis and recovery. As long as central banks can intervene, as long as money can be created, as long as assets can be inflated, the mechanism continues. But there is a limit. History suggests that systems built on prolonged expansion and intervention often face periods of reassessment, though the timing and form remain uncertain. Rome debased its currency until the denarius was worthless. Weimar Germany printed until money became kindling. More recently, Venezuela, Zimbabwe, and Argentina have shown what happens when trust in currency collapses entirely. And when such moments arrive, the same pattern may repeat one final time. In such periods, the relative reliability of different forms of value can shift in ways that are difficult to anticipate in advance. Those with hard assets, land resources, productive capacity, may retain value in ways that paper claims do not. Until then, the cycle continues. Every decade, a shock. Every shock, a crisis. Every crisis, a rescue. And every rescue, a transfer, quiet, efficient, and invisible to those who lose the most. The lesson is not that crises are engineered, or that elites gather in secret rooms to plan collapses. The lesson is simpler and more unsettling. The system, through its existing structure, tends to produce this outcome. It does not need conspiracy. It only needs time, leverage, and the willingness of those in power to preserve the structure at any cost. And that cost is often borne unevenly, particularly by those whose financial stability depends primarily on wages and conventional savings, until the day they learn otherwise. History does not repeat, but the mechanisms that govern money, power, and survival, they never really change. They simply find new names.